Let's analyze business transactions. This event is an accounting transaction that results in an increase in both assets and stockholders' equity. The first thing we do is we identify the accounts. In this case, it's cash and common stock, as well as the effects. Again, if the company is receiving cash in exchange for common stock, both of those accounts will be increasing. And again, we want to verify the accounting equation is in balance. And again, our assets of $10,000 equals our liabilities plus stockholders' equity, which is also $10,000. So the equation is in balance. This transaction results in an increase in both assets and liabilities of $5,000. The cumulative effect of the first two transactions are assets now total $15,000 and liability plus stockholders' equity also total $15,000. This transaction results in an increase and decrease in Sierra's assets. Before we discuss the next transactions, let's briefly talk about these first three transactions. The first two transactions represent financing activities. The two primary sources of outside funds for corporations are borrowing money, which is referred to as debt financing, and the alternative is issuing shares of stock, which we refer to as equity financing. This transaction is an investing activity. Once the company has raised cash through financing activities, it purchases the resources it needs in order to operate. In this instance, equipment. Now, Sierra has the assets it needs to get started. So now it can begin its operations. Although Sierra received cash, it does not record revenue until it has performed the work. In some industries, such as the airline industries, customers are expected to prepay. These companies have a liability to the customer until they provide the service or deliver the goods. When the company provides the product or service, it records the revenue. Since Sierra received cash prior to performance of the service, Sierra has a liability for the services due. Guide service is the principal revenue-producing activity of Sierra. Revenue increases stockholders' equity. This transaction increases both assets and stockholders' equity. Often, companies perform services on account, so they perform services for which they're paid at a later date. Revenue is recorded when the services are performed, so revenues would increase when services are performed, even though cash has not been received. Instead of receiving cash, the company receives a different type of asset, accounts receivable. Accounts receivable represents the right to receive payment at a later date. Suppose that Sierra had performed these services on account rather than for cash. This event would be reported using accounts receivable and revenue. Later, when Sierra collects the $10,000 from the customer, accounts receivable would decrease by $10,000 and cash would increase by $10,000. Note, the collection of the receivable does not affect revenue. Instead, Sierra records an exchange of one asset, accounts receivable, for a different asset, cash. This rent payment is a transaction that results in a decrease in an asset, cash. Rent is a cost incurred by Sierra in its effort to generate revenues. It is treated as an expense because it pertains only to the current month. Expenses decrease stockholders' equity. Sierra records the rent payment by decreasing cash and increasing expenses, which result in a decrease to retained earnings. Payments of expenses that will benefit more than one accounting period are identified as assets called prepaid expenses. The balance in total assets did not change. One asset account decreased by the same amount that another increased. In this event, on account means that the company receives goods, in this case supplies, that it will pay for at a later date. This transaction increases both an asset, supplies, and a liability, accounts payable. Supplies are recorded as an asset because they are available for future use. Recording supplies expense occurs when the supplies are used in the business. Hiring employees does not affect the accounting equation. Assets, liabilities, and stockholders' equity have not changed. But when Sierra pays their employees, that will result in an accounting transaction. Dividends are a reduction of stockholders' equity, but not an expense. Dividends are not included in the calculation of net income. A dividend is a distribution of the company's assets to its stockholders. Salaries and wages expense is an expense that reduces stockholders' equity. In this transaction, both assets and stockholders' equity are reduced. We need to total each column to summarize the transactions of Sierra Corporation for the month of October and to show their cumulative effect on the basic accounting equation. So assets total $23,300, and so does liabilities and stockholders' equity. Now it's your turn to analyze transactions. The solutions to this exercise will be provided in the next video.